Think about the last time you checked the price of silver. You pulled up an app, maybe glanced at a chart, saw it hovering around $90, and went about your day. It's a routine, a number we've gotten used to, a digit on a screen that seems to make sense within the financial world we're told is real. But what if I told you that while you were doing that, something happened so profound, so quietly explosive, that it renders that $90 figure almost meaningless? It wasn't a market crash or a central bank announcement. It was a simple, bureaucratic update on a government website that changes everything. If you don't understand the implications of what the United States Mint did on the morning of January 16th, you are operating with a map that no longer matches the territory. Here's what occurred. While everyone was focused on the ticker, the United States Mint, the sovereign entity that actually produces the nation's coinage, updated its pricing. They didn't adjust it slightly. They repriced the proof, American Silver Eagle, to $173. They set the uncirculated version at $169. Let that settle in. The spot price your broker shows is roughly $90. The government's price is nearly double. This isn't a market opinion or a dealer premium. This is the institution that manufactures the coin looking at its own currency and declaring, through action, what it believes the metal is truly worth. This gap, this chasm of almost 100%, is what I believe amounts to a sovereign confession. It is the entity that controls the printing press tacitly admitting the paper it produces is in a state of severe distress. Now, I can already sense the objections. The mint is closed for sales. This is just a placeholder price. But that line of thinking, in my view, misses the monumental signal being sent. Why would a closed institution bother to nearly double its listed price? The answer, as I see it, is front-running reality. They know that when those sales eventually reopen, they cannot and will not sell a strategic, tangible asset for a paper price they no longer believe in. To do so would be a fire sale of national resources. By setting the price at $173, they are planting a flag. They are telling anyone paying attention that the $90 paper price is a derivative fantasy, utterly disconnected from the brutal economics of physical procurement, refining, and production. This creates a two-tiered reality. On one tier, you have the digital world of algorithms and paper contracts, a realm of charts and leverage where silver is $90. On the other, you have the physical world of atoms, where the actual custodians of metal, the mints, the industries, the sovereigns, are signaling a price approaching $200. When the spread is this wide, the market isn't discovering price. It is revealing insolvency. And this is just my interpretation, my connecting of the dots. But consider the timing. This repricing happened immediately after a failed attempt to smash the paper price down. The banks tried to drive it toward $86, but it held and closed the week above $90, a historic weekly close. In direct response, the mint's number leaped. This feels like a silent war between the deflationary force of paper and the inflationary truth of the physical. The mint, by its action, has chosen a side. They've aligned with the inflation trade, admitting that it now takes almost 200 of their own dollars to buy a single ounce of silver they produce. This is the quiet crisis, not a crash, but a great repricing, where tangible assets leap in dollar terms to reflect the hidden erosion of the currency. But if the mint's new price was the declaration, what happened in the vaults that same day was the execution. While the website was being updated, a silent, staggering exodus was occurring. On Friday, January 16th, over 4,200,000 ounces of silver were physically withdrawn from the registered COMEX vault system. This isn't a statistical blip. This is 130 metric tons, a convoy of armored trucks, a cargo plane's worth of metal, vanishing from the exchange's available inventory in a single day. The withdrawals were coordinated across every major depository: Asahi, CNT, JP Morgan, and others. This was a systemic raid. And here, in my analysis, is where it becomes alarming. This massive physical removal happened on the exact same day the paper price was artificially crashed. Is that a coincidence? I don't think so. If you are about to withdraw 4 million ounces, every dollar you knock off the price saves you millions. A $6 crash saves you $24 million. This has the hallmarks of a heist: engineer panic and liquidate paper positions, then quietly haul away the physical metal at a discount. The most critical detail is the vaporization of registered stock, the category of metal actually available to deliver against contracts. It plummeted by over 2.5 million ounces. This is the buffer, the liquidity for the entire paper edifice, and it is being deliberately stripped away. The owners are taking the for sale signs down. They are hoarding. Perhaps they know what's coming: rumors of strategic national stockpiles, of export controls, and want their metal in private, secure hands, not in a public vault where it could be frozen or commandeered. We are, in my estimation, watching the liquidity of the system vanish in real time. At this rate of drain, the registered inventory could be critically depleted in a matter of weeks. This brings us to March, a major delivery month. What happens when contracts demand delivery and the vaults are bare? This is the force majeure scenario, the exchange admitting it cannot deliver, settling in cash. But industries don't want cash. They want silver for solar panels, for electronics, for defense. The Friday night withdrawal wasn't just a trade, it was the smart money building a lifeboat. Now, in the middle of all this institutional frenzy, I want to take a moment to talk about you. If you're finding this breakdown valuable, if it's helping you see the chessboard behind the checkers game, then consider joining this channel. We try to connect these dots every day, to look past the screen and see the physical reality. Your subscription helps build a community that sees through the noise. Now let's get back to the other half of this story, the public. Because while the whales were draining vaults, the retail crowd was making history in its own way. Data shows that investors have been net buyers of the largest silver ETF for 169 consecutive days. That's nearly 6 months of relentless, unbroken accumulation, a streak that surpasses the famous 2021 squeeze attempt. In the last month alone, almost $1 billion has flowed into these funds. The public instinct is correct: a migration out of fading trust in paper assets and into something perceived as real. But this, in my opinion, is the great tragedy. This monumental wave of capital is pouring into paper ETFs, not physical metal. When you buy a share of SLV, you own a paper claim, not a bar. And the custodian of that metal, the same banks we just watched draining the vaults. The conflict of interest is staggering. When the crunch comes, who gets the actual metal? I suspect it won't be the ETF shareholder. They are likely to be left with a cash settlement in the very dollars they sought to escape. This retail swarm is colliding with the bank's greatest vulnerability: their own staggering short positions. Some analysts estimate major banks sit on a combined short position representing billions of ounces, years of global production. They have sold silver that does not exist. They are now trapped between an unstoppable force, relentless public buying, and an immovable object, disappearing physical inventory. Every price smash they engineer to scare sellers only brings in more determined buyers, strengthening the swarm. The ETFs act as a pressure valve, soaking up demand into paper, but that valve is nearing its limit. When the paper claims vastly outnumber the physical atoms, the structure implodes. So, where does this leave us as Monday approaches? We have a mathematically impossible situation. The screen says $90. The sovereign mint says $173. The vaults are bleeding millions of ounces a day. The banks are catastrophically short. The public is buying like never before. This, in my final thoughts and speculation, is a powder keg. Markets abhor such vacuums, and equilibrium will be forced. The paper price cannot stay divorced from physical reality forever. I believe we are set for a violent reckoning. The only viable resolution is for the paper price to gap up violently to narrow that $83 chasm. When markets open, the news of the mint's price and the vault drain will circulate among global traders. The realization will dawn that $90 is a profound mispricing. We could see a rush for the exits from the short side and a panic to secure any remaining liquidity. The great repricing isn't coming. It has already begun in the physical world. The screen is the last to know. Therefore, my advice, based on this entire picture, is simple. First, if you hold physical metal, do not sell. If the paper price jumps to $110 or $120, remember it's still a deep discount to the mint's reality. You're trading a scarce asset for a currency in decline. Hold. Second, ignore the volatility. The banks will likely try more price smashes to trigger panic. See them for what they are, desperate acts in a dying game. The real story is in the vaults, and the vaults are emptying. Third, watch the spread between the paper price and the physical premium. That gap is your compass. As long as it remains wide, the pressure is building. We are witnessing the unraveling of a decades-long illusion. It is chaotic and often counterintuitive. But for those who see it, the message is clear. The United States Mint just told you what it thinks silver is worth. It told you it's worth $173. The rest of the world is still pretending it's 90. That disconnect represents the opportunity of a lifetime. You now have the information. The choice of what to do with it is yours.